Hi, everyone. Welcome to this live TV show. As usual, I'm here to share with you my views of the market for this week. As you know, we have a lot from a macroeconomic uh, point of view, not just because of calendar, but because of, uh, well, now Donald Trump has begun the new U.S. president. Let me share the calendar with you. Here we are. And as you know, the first measures he has been taking and the first word he has been given to the public had been quite disappointing because uh, pretty much everything he said, he's reiterating his campaign speeches, right, and has given no clues about the upcoming tax cuts or infrastructure investment he has promised once he won the elections, right? So the market is fulfilled with uncertainty. Moreover, after right now, a few minutes ago, the Supreme Court in the UK has voted that the Parliament has to vote to approve the government's exit plan, right? The government will need to approve any kind of negotiation Theresa may want to do. And while most of the parliament, both houses, are willing to respect the people's will, the fact is that we can see some opposition coming from descendant lover and mostly, I do believe, by Scottish nationalists, right? And I'm beginning to think that there's a possibility of another Scotland referendum, right, to leave the United Kingdom. We have one a couple of years ago. We may have another one these days. So everything on the matter is telling us that the Brexit, right, the beginning of a Brexit, in fact, which Theresa May wants to trigger by the end of March, sorry, will probably be delayed, right? So that will generate further uncertainty. Anyway, with Trump as US president, we are having a very weak dollar, and the situation seems to be persistent, meaning I don't see much of a case of a dollar recovery for these upcoming days. So let's check the macroeconomic data and what we have ahead for this week, and then we will go to charts, okay? I was checking the preliminary market sector, market PMIs for Europe, and despite the European area, right, most of the countries have continued to grow during January. Seems to be a lot slowdown in the service sectors. Readings are really strong still, but are below market expectations. I don't believe that this is something that we should care of because it's not that the economy is shrinking, right? But there's a first sign of alert in there. But I believe that later today, attention will focus in the US PMI, right, and existing home sales. Remember, guys, as of lately, readings in the housing sector have been slightly below expectations, showing contraction, small retracement, but still failing to support the greenbacks, failing to support the case for a strong role in the United States. Housing sector is the one in trouble these days. Not employment, not inflation. I know the Fed bases its decisions in inflation and employment. Maybe the housing sector, you think it's not relevant, but don't forget that crisis back in 2007, 2008 was triggered by a collapse in the housing and mortgage sector. So uh, these readings may be more relevant than what you think and may affect the greenback even further if we have negative numbers today. Okay, for tomorrow, for this Wednesday, right? Inflation in Australia will be the main market mover during the Asian session. The Aussie has been quite strong lately, mostly due to improving economic signs coming from China, right? China is the biggest importer of metals. Australia is one of the biggest producers. So and that's what's boosting the Aussie these days. However, inflation has been soft, to say the least, in the country. And given that Canada has said that with the uncertainty generated by Trump, they are willing to cut rates, I won't be surprised if a negative number in here puts the Reserve Bank of Australia in alert, right? The Reserve Bank of Australia usually meets the first days of the month. I don't believe they will meet this next week because the month starts next Wednesday, but probably the next one. So beware of these inflation readings to affect the Aussie and therefore commodity related currencies during the Asian session, right? Then I don't pay too much attention. The fact is that New Zealand inflation could be more costly, but it's hard that any figure coming from New Zealand can affect the rest of the market, right? So, well, if you're an Asian trader, you will like to take a look at this. And the concept for this is the same that it went for the Australian one, but it hardly affects the rest of the market, right? On Thursday, I do believe that the attention will center in GDP growth in the UK. Okay, it's the preliminary reading for the last quarter of 2016. In general, the market is expecting some stability in the year, given the data coming from those days has been quite stable. We have seen a small setback in data starting in December in the UK. So I believe that a big disappointment in here could push a new turn in the pound, but I'm not expecting such a disappointment, not something like 0.2% or below. That would be a disappointment, which I'm not really expecting, okay? The other half of US PMIs will also be released on Thursday alongside new home sales. Goes the same as we discussed. Inflation in Japan this week. The market hardly reacts to this news, but the fact that inflation belows within negative territory is a bit discouraging. Okay, we're not expecting much of a change in the year, but neither we are expecting the Bank of Japan to refocus in inflation and these numbers. I do believe that they will hold on to their policy of zero or near to zero rates divergences. So mostly I don't expect this to be much relevant unless we have big disappointments, okay? And finally, what I believe everyone is expecting on Friday, the first estimate of US GDP for the last quarter of 2016 is expected to have a downward revision. Sorry, it's not a downward revision. The third quarter final reading was 3.5%, and the economy is expected to have grown by 2.1% in the last quarter. So, despite it's well below the previous one, it's still a nice number, right? And anything above this level should help a bit the greenback to recover some ground, right? Anyway, let me change the charts, and we can see the levels to take care of these days. Here we are. Here's the euro. I have this Fibonacci retracement coming from the post US election high around 12.99 down to this January low of 340. As you can see, the pair has been pretty much last week batting this 710 price zone, which stands for the 38.2% retracement of that movement, and it has broken higher, but still has faced a major resistance earlier today in the Asian session, which is the 100 simple moving average in that daily chart. So far, capping the upside around 770, right? The highs we have, the moving average, above that level. Moreover, if US data results disappointing, I could expect the pair to rally up to 800, 840. We have the 50% retracement around 820. In between 800 and 840, the pair has a huge long-term static resistance area. It has been the base of the range pretty much all of through 2015 and 2016. So a break above that level will take more than dollar weakness. I do expect that if this region is reached, the pair will correct something lower, right? It won't be able to break the first attempt, at least that's what I'm thinking at this point, unless we have, I don't know, really huge disappointing news coming from the United States. Something I can't see. Besides, don't forget, the euro is still not a strong currency. The euro is still weak. The euro has still a lot to face this year with elections in France, um, uh, and with growth figures that are slow, still slow. Uh, Remember what Draghi said last week. A positive inflation figure last December was not enough. They need to see more stability in inflation growth. So actually, not expecting much more gains beyond that 800, 840 region. On the other hand, of course, the immediate support is that 700 price zone, which is the Fibonacci retracement. Below that, the pair has been finding some comfort around 650, 660. The next support for this day is 600 come next, and finally 565, which is the 23.6% retracement of that um, slide. Okay, I can see the dollar regaining some strength, more sustainable strength in the mean term, only on a break below this level. Okay, if this level holds, I don't see much of an upward potential for the greenback. And still, I don't see much of bearish strength right now coming from technical readings in intraday charts. In fact, everything's suggesting that the pair will probably continue advancing, at least at slow pace, maybe towards that 800 region, but not much more. Okay. Sorry, let me go to the pound. There was some upward momentum going on in here, but after the court ruling, the market rethought that strength and it's pushing the pound slightly lower. I still believe that this movement, this post Theresa May hard Brexit announcement, it's corrective in the long view. And I believe that we discussed these gains above 125 are unlikely to be sustained. And it's the last line in the sand where the selling interest will probably research something that's actually going on right now. Okay. I do believe that the immediate support and level to watch will be the 2410 20 region because we have previously highs in that area, quite strong ones, but in general, right, in particular with bigger time frames, the movement seems pretty much an corrective movement. Nothing is telling me in here that the pair is ready to regain its upward strength, and that's the bottom in the pound. I believe we are far from that. And until the Brexit is triggered, the negotiations begin. I don't see much of a case for sustainable pound strength when we are going to see these corrections in the middle, but mostly range bound long term. Anyway, below that 24, 10, 20 region, pair can go down to 2360, right? There we go. We have multiple intraday highs and lows in the region, but I believe that the key is 2330, strong, very strong static support level right now. It has contained the upside for over a month back in October, November. It has been a tough level to break either to the upside or to the downside. So I could expect this level to hold, okay? At least this week. If it doesn't, then the risk will turn back towards downside and their pair will have scope to test these lows, recent lows in the 2250 price zone, okay? I'm not daring to risk much of buying in here, to be honest. Uh, Above this high, the pair can extend a bit more. Okay, I'm looking for up to 26 probably, right? We have also strong static resistance area there, but I do believe that at this point, the market is more willing to sell the rallies than to buy the dips. So beware of that. I can't see a clear buy in the pound at these levels. Okay, when it comes to the Aussie, well, we have breakthrough to this Fibonacci I had draw. We're at fresh 2 month highs in here, as I'd say, and I do support the case for a stronger Aussie. If you take a look at your charts, it has streamed almost every losses from the post-elections. Right, we're not far away from that. It's the one advancing the most against the greenback, against the commodity currencies. And I do expect this trend to hold, right? As we discussed in the latest coverage, um, there's the risk that when the pair get closer to 77, the Reserve Bank of Australia will begin to get nervous and jawboning about the strength of the local currency. But actually, the market does not pay much of attention to those comments, right? And secondly, I don't see them cutting rates just because, or moving rates just because the Aussie is strong. However, keep in mind that if inflation readings this week disappoint, indeed, the Aussie will suffer. Okay. Anyway, for the most bullish, I don't see much of a downward potential going on in here. The pair has traded as high as 76.08 so far today. So far, the gains above that 76.10 price zone will probably lead to an approach to the 77 region. Honestly, I do believe that that's the highest we can go this week. Not expecting much more upward momentum from this particular one. Not saying that the pair will reverse those levels, but pretty much thinking of some consolidation to take place around it. Okay, and until we get further clues, either coming from Australia or the US. The US is clueless. Anyway, uh, if you take a look at this for our charts, around 75.50, the market has been willing to buy. So for me, that's the immediate support, followed by 75, 74.90. In fact, that's the level I'm watching. I do believe that it will take a break below this one to see the pair falling further. And in that case, 74.50, which is a major long-term, really big Fibonacci support and a strong static support level comes next. That's the level, the probable bottom for the pair in the case of a downward corrective movement. I would expect buyers to research around it and keep the downside limited. Okay. And for the dollar Japanese yen, there was that wild recovery by the end of that last week. But the trend is bearish for me. I do expect further declines. We have, in fact, extended previous week lows by a few pips today. So honestly, I'm seeing some further slides ahead. It's true, we have this 100 simple moving average in the daily chart heading higher, and therefore offering a major long-term support, but that does not mean that the pair can go down to 100, which is where the moving average is extending. 1250, it's the immediate support. The pair has bounced so far a couple of times, so from there, weekly basis, so seems quite strong. I would take a look at this Fibonacci level around 1190. If the level gets up, we'll confirm the break lower and therefore signal a decline towards that region. To be honest, I don't see much of an upward potential as long as the price remains 1460. Okay, that's for me the level to watch. And even though above that level, the pair would need to surpass this previous week high around 1560, right? We have some sort of room in there to grab some pips towards the outside, but it will take some follow through beyond it to talk about amount bullish extension in here. And I can't see it right now. Remember, we talk about Japanese yen usually appreciating in February, despite the fiscal year rules on repatriation had changed around, I don't know, 5 years ago, right? Anyway, the market tends to buy the Japanese yen ahead of the end of the fiscal year in Japan by March 30th, okay? So usually February, March are months when the yen gains ground. And when it comes to oil prices, there's not much going on in here. It remains within a consolidative phase, right? We have that short-lived decline towards 50, but pretty much is holding about 52. To the optimism triggered by the OPEC with their output cut, right? Now we have a post in higher production in the US. There are several reports from the oil field companies saying that the US it's rising its production and will keep on doing so starting February. So that is what's keeping the price contained. I believe that we discussed many times the fact that there's not much upward potential beyond 55. I don't see it coming, to be honest. I don't see it either break below 50 unless we had bad news coming from the OPEC, uh, meaning that the countries that have signed the deal to cut output begin to produce or export more. That would be bad news. And more uh, production in the US, right? Or the other countries outside the OPEC. Not much, but there are others. So watch for those two factors to put the price, push the price lower. And of course, it will take a break below 50 to do so. But honestly, I'm seeing the oil holding in between the 50, 55 range for maybe a month more or so, a couple of weeks at least. Okay. Uh, and finally, let's take a look at gold prices. The fact is that it's having pretty much the same behavior as the euro, right? We have an interim bottom, a relevant one, a corrective movement reaching the 38%, struggling around it, finally breaking, but again facing resistance around the 100 simple moving average in the daily charts, right? So technically, I do believe that chances for further gains in gold are less than within the common currency. Because at the end of the day, let's not forget that Chilean has said that they are willing to raise rates a few times per year until they reach the 3% target by 2009, right? So that should keep gold prices limited. I don't discard the spike above those highs and even an advance up to this 1230, 33 region. Sorry, but that's the most I can see it advancing. I don't believe that the gold prices can go any further, and if they hold around this area until it's way too long to forecast, but if they hold in between 1150 and 1250, let's say, until June, when the Fed is expected to raise rates, then we would probably see a fall below these lows that we had late December. Okay, but anyway, go to the short term. As I said, this 1220 region 16 is where we have the 100 simple moving average, and around 20 where we have the heights. So about this last rally up to 33 seems likely, but honestly not seeing much more coming from there. To the downside, immediate support is 1210. Below that, we have this Fibonacci level, but to be honest, the price has not been respecting it much. We have some congestion moves in here, quite messy region. I will grab this low, right, around, okay, 1195.81, it says. So I could like the metal to break below this to talk about entering top at a probable break lower. Now that I'm watching this 4-hour charts, there's sort of a double roof going on in here with double top with the neckline around that 1195 level. Okay, $24. Hey, so the break should target 1170. Okay, region. Break below this level could probably end up going out down there. But still, the 1200 price zone has been quite messy. Okay, so beware on a decline, wait for a confirmation until it falls below 1195. Okay, I believe that's it for today. Thanks for being here. Thanks for sharing your time with me. And I believe that I will see you next Friday with yes, GDP live coverage. I believe that Yohai and Mauricio will be with me as usual. So thank you and see you back then. Okay. Thank you. Bye-bye.